Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's January 23rd. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Man. We just came back from Vancouver. Really great trip. Super busy, lots of meetings. And while I love that city, man, it is a pain in the ass traveling to Vancouver from Florida. Well, from Jacksonville, Florida, northern Florida. Since there's no direct flights, you have to take 2 or 3 flights to get there. Got to wake up at 4 a.m. on Saturday to get there around 2 p.m. Pacific, at 5 p.m. And then the way back, which was last night, I had a 4-hour layover in Newark. Think about that. I had to fly to Newark. Usually, I could fly to Chicago, Texas, even Atlanta if it's Delta, and then fly to Jacksonville, which is only an hour away. The only thing I could find was a trip going through Newark, which is insane, right? Because we all know it's the worst airport in the world, the most delays. It's always crazy there. And since I booked pretty much late after the Consumer Electronics Show, it was very important for me to be at this conference. Okay, it was definitely worth it. It was great, but holy cow. The 4-hour layover, I was like, okay, I'll just do some work. It'll be fine. You're just getting your head right for it. But I don't know if you saw the news yesterday, but they shut down all the flights basically because there was drones flying around in the area. So they grounded like most of the flights, or nothing took off. They delayed. So they started to delay them for a few hours, and then it was like 9:30, 10, or about 10:15. It was scheduled to leave. I'm like, all right, and sure enough, we have maintenance issues, which caused a further delay. So we wound up taking off around midnight, and I got home close to 4 a.m. last night. But I don't know why I flew United. I hate United. Yeah, it's the only flight I could really get other than if I want to take 3 planes home from Vancouver, which is nuts. But I'm not sure why they didn't work on this plane when it was grounded, right? It's like they had to turn on. Then they realized there was maintenance issues. And then when we got on the flight, they said, yeah, this is the second time we had maintenance issues with this plane. And let me tell you something with United. This was an express plane, they call it. A very small plane. It must have been from like 1980. I'm like, old leather seats that had tape on them. The engine was super loud. The seats were squeaking when you sat back in them. It's just a really old, ugly, uncomfortable plane. And then we're flying out of Newark since, that's the worst airport in the world, like I just said. But these express planes don't even go to the terminals at Newark. They're just like in the middle of some runway where they're like, okay, and they open up a door and you think you're just going to go down and get on the plane. And it's actually to a bus that drives you probably close to 8 to 10 minute drive, and then you got to get out in the cold and walk onto the plane. Anyway, I should have a small violin playing in the background, right? While I complain here, because everybody's like, all right, just get on with it. But man, I love this podcast. Sometimes it's stress relief. Complain and rant about all my problems. Anyway, I wound up leaving 6 a.m. from Vancouver, and I got home 4 a.m. my time in Florida. So if I sound a tiny bit tired, you know why. The good news is the trip was absolutely worth it. And it was a success. Had some great meetings, especially about tokenization. I'm bringing this to a lot of people there. And when I'm sitting down explaining it to them, they're having the same reaction as some of my best contacts, fund managers of the industry, going, holy cow, this makes sense. Or we could pull out certain assets out of our portfolio and tokenize them. And as I'm explaining, and the interest was incredible. I mean, the timing of this announcement couldn't be better. But I don't know if you saw it, but IBM announced a partnership with Securities, who we're partnering with to launch a security token. And even the headline, it said they're working together to accelerate the program to tokenize the $82 trillion corporate debt market. So, guys, the trend's here, okay? You still have plenty of time. You still could do amazing things. I told you that I'm good friends with one of the largest independent bond fund managers who wants to raise a ton of money through tokenization because he's sick of just giving away fees to investment banks. And here it is, $82 trillion. So for me, when I say this is going to be a $1 trillion industry, which a lot of people laughed at me, there's, looking at the debt market and real estate, we're looking at $300 trillion in assets that are illiquid that have the chance or the opportunity to be tokenized. If a 0.5% do this over the next 5 to 7 years, which I think it's going to be more than that, guys, we're seeing it happen right now. I've given you examples. I won't talk about them anymore. I mean, we're looking at $1 trillion industry. And right now, I feel like so many people do not go to the mining industry. You're talking to biotech, just talking to different people to different industries. When I'm talking, they're like, wow, I'm like, it's Uber. It makes sense. You drive an Uber, you would never take a cab again. It's cheaper, it's safer. Don't worry about guys hanging on the door, getting in and out or anything. It's just you get in, get out. Everything's with your app. You can talk to the driver. It's amazing before he gets there. Again, this makes sense. And that's why you're seeing these big announcements now with IBM, by the way, just blew out earnings. I'll talk a little bit about it later. But the VRIC was awesome. I'm going to break down that conference education segment and also share some of my favorite ideas like I always do. But first, a very special guest who I'm about to interview. First time interviewing her, and I'm a huge fan. Her name is Clare Flynn Levy. She's the founder and CEO of Essentia Analytics. So Essentia basically provides behavioral analytics and coaching for professional investors. So its analysts is currently being used on nearly $40 billion in aggregate assets under management. So basically her specialty is behavioral analytics. Now, what does that mean? She breaks down the performance of hedge funds, mutual funds over a time period and analyzes their behavioral patterns, or the portfolio's managers' behavioral patterns. And she came out with studies with her and her firm. They're published. They're going to blow you away in terms of how portfolio managers would manage differently or do unconventional things based on market conditions. So Clay uses these analytics, this data, to help portfolio managers improve their performance, where it's kind of like she's a coach, helping them out, helping them to improve. It's very powerful, something I think individual investors will identify with, since we all have emotions, nervous during bear markets, and more optimistic during bull markets, put more money in during the wrong time. And real quick, before we get to this, because Claire's not someone on the sidelines that's good at math, algorithms, said, hey, let me create a software program to help investors. No. She's a portfolio manager at Deutsche Bank for over 10 years, managed a hedge fund, was a superstar tech analyst during the internet boom, winning numerous awards. And this is what I love about her. Because once a tech bubble burst, instead of blaming everybody else or whatever, she, got smoked just like everyone else covering that industry, most tech analysts. But instead of letting ego get in the way, she asked herself, what can I do differently or better to help out her performance in the future? How do you avoid these mistakes? And this is what she came out, led to her finding Essentia Analytics. I love that approach, and I respect it. Again, it led to her creating her own company. So I'm going to let Claire tell the rest of her story. It's a great interview, guys. You know what? Let's get to it right now. We're talking to Clare Flynn Levy. Thank you so much for joining me in Wall Street Unplugged.
It's my pleasure.
Well, I was doing a lot of research on you, and because I was just fascinated, because you are an analyst, you have an analytical background, and since you're a first-time guest, let's get into it a little bit and talk about your company, Essentia Analytics. What was the motivation for starting it, which I know, but I think it's going to really look good in front of the audience, and how you decided to say, hey, how do I become better, which every individual investor, every PM wants to do, but a lot of us sometimes have too big of an ego, but you put that aside and started Essentia Analytics. Why don't you tell me a little bit about your background?
Sure. Well, so, I was a part of the first generation of kid that grew up with a computer in their dorm room. And I became a tech specialist pretty early on in my career. I started my career in London at a fund management firm called Morgan Grenfell Asset Management, which was owned by Deutsche Asset Management. And just on the edge of the internet bubble, I joined them in 1995, and then and was harping on about the internet all the time, and people were shushing me a lot, and then suddenly they were not shushing me, and they were wheeling me out, and I became the resident tech specialist. So I built a career as a fund manager, specializing in tech, having hit the ground at like the best possible time to be lucky, and not necessarily skilled, although, who's to say whether it was luck or skill? Nobody can say, because they didn't analyze the data. And, I went through this 5-year period of everything I touched turned to gold. I won all the awards. The industry revolves so much around performance as a measure of skill that, it gets confused, and it rewards fund managers for recent performance and not necessarily for, what they're doing that underlies that performance, because so much of that is skill. Is luck based. As I found out, when the bubble burst. So by then I was running a long short tech strategy, still in London, and what I had learned to do as an analyst and my process was just not working anymore. And I was trying to figure out why. What is it that I should be doing differently? Somebody just please tell me. And nobody could. People had opinions about what I should do differently, like you should just make more money. Okay, thanks. That's that's really helpful. But what I wanted was somebody to analyze data on every decision I had made before, and tell me, which types of decisions are you making well and in what circumstances, and which types of decisions are you screwing up over and over again. I'll do more of the thing I'm good at and less of the thing I'm bad at if you could tell me what those things are. And that's really what, lies behind Essentia Analytics. We basically do that job for fund managers.
Now, how difficult is it? Because I can identify with your story, because my dad, and I grew up in the financial newsletter business. I grew up as an analyst, where my late dad was an analyst for 30 years, managed money, also had a newsletter. And then I realized, hey, you know what? I was running his company and realized I needed to learn more. There was just, I wanted to learn more. So I worked for Jim Cramer for 5 years as a research analyst. And my dad was a value specialist and Cramer was a growth specialist. It was two totally different styles of investing. And that's when I realized, when I interview people, where it's never, hey, let me attack this style, even if I don't agree with it. I want to learn more to try to better myself, right? I feel like the people that I talk to in this position, though, they have these big egos sometimes, and they're professionals who you're targeting. Mm-hmm. Is it ever difficult to tell them and say, hey, you know what, here's what you're doing wrong? Because a lot of these guys think they don't do anything wrong, when in the end, we're all predictable, we're all going to make mistakes. But in order for this to work, you really have to check your ego at the door, right?
Well, it's so funny. I just got we send out very targeted emails to fund managers who we think are going to likely benefit from what we do. And I got one back this morning, and I see I actually see the responses that people write back. And this guy said, I've been a fund manager for, I don't know, I forget what the number was. Let's say 40 years. It was a high number, more than 30 years. I bet I could tell you a thing or two about being a good fund manager. And it was like, oh, wow. Okay, that's not our target customer. There are people in the industry who absolutely are not up for acknowledging where there is room for improvement in their investment process and make this assumption that they're perfect at everything, which is very, dangerous. That's a big red flag. If you ask me, I was just talking to a group of allocators at a very large fund the other day about, what should they be looking for in managers. And I said, you know what, the first question to ask them is whether they have looked at behavioral analytics. Have they looked at their own data on their own decision making, like an athlete would do, actually looked to see what is it you're good at and what is it you're not good at. And if they look at you blankly, like, that's all you need to know, because there is a breed of fund manager that is starting to behave this way, that is very not only open to it, but sees that that's the way forward, just like any pro athlete in this day and age wants analytics. Like, that's how you become the best. Those people, even they don't enjoy hearing that they're not perfect at everything, but they acknowledge that of course they're not. And if you know about the thing that you're doing repeatedly that's hurting you, you could do something about that. And so they get excited about the opportunity to reap that alpha, that they're giving up, because they actually have control over their own behavior.
It's funny you bring up athletes, because athletes, I think, they're still young, right? Because I know I'm in pushing 50, believe it or not. Oh, I'm getting up there. But athletes are coachable, where it's in our blood, right? We're men. As we get older, we get stubborn. We're set in our ways, especially when it comes to our craft. But I could see a lot of pushback in the industry, but and I'm sure it requires a lot of patience, because all you're really trying to do is help. Now, I want to get to the data and your white paper and holding the line. Let's go over some of the results of that, because it's fascinating when you're talking about how PMs, portfolio managers, act differently depending on market conditions, right? They're going to change. Instead of having the same investment style, they're different when they're on winning streaks. right? And we know the probabilities of winning streaks where it's just, people think like they're great and it's going to continue forever, but they also act a lot different during losing streaks. Could you talk about some of the findings in that white paper?
Sure. Well, so the biggest finding that isn't in that white paper, but that's sort of worth mentioning to start with, is that people's investment behavior is a lot more stable than they even think. So most of us think, well, I'll behave differently in a bear market than I do in a bull market. And actually, that's not true. What we see in analyzing, lots and lots of different portfolio managers' data is that each person, we each have our dance moves, and it doesn't matter what music is playing. Maybe you have two sets of dance moves, one for hip hop and one for other kinds of music, but nobody has a massive repertoire of moves. And some of your moves look really good, and if you had a mirror in front of you, would be psyched about it. And other of your moves, probably if you had a mirror in front of you, you wouldn't do that move anymore. So we often get clients say, well, I think my behavior changes in different markets. And then we said, well, maybe let's have a look. We analyze the data. And the answer is actually, no, not at that sort of macro level, looking at it across decades or, years, but where people's behavior does change very subtly is when there is volatility, either around share prices or around their own P&L. And that's where the white paper is about how do fund managers, how does their behavior change when they're on a winning streak or when they're on a losing streak. And we define a streak as 5 consecutive days of winning or losing. So and some of the investors we looked at are very long-term investors who, if you ask them, would say, oh, no, I don't change my behavior on a 5-day streak. And yet they might well do. So what we found was that half of portfolio managers, and we looked at 29 of them from 21 different firms all around the world. So a decent data set. Half of those did change their behavior with regard to how much they were trading, how frequently and in what size they were trading, and on a winning streak or a losing streak. Half of them didn't change their behavior, which is really interesting, because when we asked a room full of portfolio managers in November, how many of you think you probably change behavior when on a winning streak or losing streak? 85% of them said they think they do. But actually, only 50% of them did change behavior. And then of those, they changed it in different ways. But the people who changed it the most, there was 35% of the overall pool were people who changed their behavior quite significantly, both on a winning streak and on a losing streak. So they were sort of reactive to the streak. And what we found is that when they were losing, they traded more and they traded in larger size. And when they were winning, they didn't necessarily trade more. They actually often traded less. But in both cases, the hit rate and the payoff ratio, so the sort of batting and slugging scores on the trades that they did during that period, if you looked 6 months into the future, they did worse. They were making worse quality decisions while they were on the streak than they normally did, which is, at the end of the day, it says, okay, if you're one of those 35%, which, Essentia could tell you if you were, by the way, if you were one of the 35%, you could be, stopping yourself. What an Essentia client would do is get a nudge from us that says, careful now, you're on a 5-day streak. You might well be aware of it. Just saying, historically, you've had a tendency to overtrade in this situation. It's not worked out well. You can still trade. No one's going to stop you. You could ignore us. But actually, if you really want to do well and you believe the data, you're going to take that into account, and you're going to maybe think twice about trading so much.
See, I love that. Now, you've been taking data from what I saw with the study since 2008. Is that correct? From your white paper, right? I believe. Yes,
that's right.
Okay, so now it's great because you started a good period where it's all about you keep managing data, learning, right? You're getting better at it. But I'm wondering, did it ever factor in, because managers do act different when the market's down, but when you're looking at PMs that manage money, sometimes, especially in a crazy period like 2008, and maybe a little bit what we saw late this year, right, with a big sell-off. where you might see redemptions, which is kind of forced selling. Now, does that take into account for anything? Because I know there's like, listen, you want to get the average data sets and what works. So I'm just curious, does that factor into anything where I guess it could be more of a sentiment indicator where it makes sense. But then when I see, especially like take it, industry specific like mining, where, there's tons of redemptions have been going through the industry for a couple of years. I wonder, does that factor into anything?
I mean, you definitely could factor it in. We didn't do it with the white paper because we were talking about P&L, 5-day P&L streak, so it shouldn't really be related to redemptions. But typically, though, our data is looking at accounts where cash flows aren't necessarily affecting them directly. But if a PM is experiencing a lot of redemptions, that does change how they manage even the fundamental, decisions that they're making. So that's probably an analysis in and of itself to look at, what does it look like when the redemption, I mean, God knows I've lived through it. I know you manage money differently. But how differently? And is there a better way to handle that situation from the PM's point of view? Probably. That's an interesting one. I'll add it to our research list.
It's good. Almost like it's when I trade, not on purpose, but just, it's something that I'm interested in. So I'm just curious because I'm with you. I want to be better. I want to, you want to be the best because there is a responsibility we have as people that listen to us, right? I mean, sometimes that gets lost where people are giving us some money. For me, people are listening to me on every word that you say, and you want to make sure, you're the best possible. And if that's looking at it from, hey, take a look at my performance, let me know how I could do this better, everybody's going to benefit, right? It's so much better. So, and again, a lot of people have trouble checking their ego out the door, do that. But, I know that you don't, and I don't. Because
and there are others, Ray Dalio doesn't, there are others out there who take the same point of view. And you have an opportunity to demonstrate, as you have done, here's where I'm wrong. Let me show you what it looks like to be wrong. It happens.
Because for me, I'm so competitive, and when I see everything line up absolutely perfect, that's when I get worried. Yeah. When it's kind of like when I'm worried about recommending an investment where and I wanted to talk to you a little bit about this, because when it comes to an investment, for me, it's, and I've been fortunate and humbled to have, pretty big following the podcast and been doing this for over 25 years, just writing financial newsletters. But when I get negative responses of something that I recommend, I love that. I think I'm going to be right compared to, so you're talking about behavioral. Does that work into sentiment as well? Because it's like, here's how I act during these times, but then that could be, what my sentiment is going to be or how it's going to change, going in the future. Now, I know maybe I'm babbling here, but I'll give you a good example. For me, one of the leading indicators, contrarian indicators I would look at is if all the analysts, like on Apple, there was over 40 sell-side analysts covering it, every one of them was just raising their estimates, even though growth looked like it was slowing. And every one of them had a buy rating and not one sell rating at all, right? So it's kind of like a sentiment indicator. And I don't know, is there any way to look at behavioral patterns and sentiment, or is it two totally separate things? I mean, I don't know.
Well, the work we do is about looking at your own behavioral patterns as opposed to, the market's behavioral patterns or the analyst behavioral patterns. But there are some really interesting funds and products out there that are specifically dedicated to looking at sentiment in the market. And it might be looking at, what analysts have buy recommendations versus sell, but actually it tends to get way more complicated than that. And there's a guy called Tom Howard who runs a fund called Athena Invest out of Denver that is a quant fund effectively, but based entirely on this idea that, the market is just a bunch of people behaving, right? And they overbehave and they underbehave, but it is actually predictable, more predictable than, a lot of the other data that people look at about the market. So if you create an investment strategy totally based on that, you're going to get some volatility, that in your performance that it might or might not be appropriate for institutional investors, but you are going to perform, well over time because it's like really obvious when you think about it that, people, when all the analysts have a buy and everybody's overly bullish about Apple, the risk is on the downside. That's just how it is, and if you could actually programmatically, act on that, yeah, you can make money.
Now, I want to ask you about, so you've been in this industry for a long time and you did a great job talking about technology, but how you were a tech analyst, but also you worked at Deutsche Bank for 10 years. You're a hedge fund manager as well. So you've been in the industry for a long period, have that experience. Today, are you seeing more PMs turn to you and say, hey, I want to, look at this or improve, or, the behavioral analytics side? Or is it like what's the demand? What are people doing now? What are you seeing in terms of your company? Or is it because you're reaching out to them, or is it people are actually reaching out to you, or is it becoming more mainstream?
It's definitely becoming more mainstream. And it's a sort of confluence of behavioral finance becoming more mainstream and being part of the CFA curriculum and being taught in universities. So you have a whole generation of people starting out in the industry who understand behavioral finance as a fundamental piece of economics that my generation certainly didn't get taught that, and they're very into data analytics. They're very used to data analytics in their everyday life. So you have those younger people who are coming through, and then you have people who are sort of in their, let's say, 30s to 50s. So the sort of middle band, where it's a mixed bag. There's some people in there who are just not ever going to be up for this. Now we're dealing with professional fund managers, right? So they're looking at their job and their sort of timeline in their career. And if they think that they've only got about 5 years left, they might well make a choice to not rock the boat. And, I don't want to look in the mirror. I'm going to just leave it. But if they think that they have more than that, or they want there to be more than 5 years left because of what's going on in the fund management industry, the survival of the fittest is getting, cranked up quite significantly. So if you want to survive, then you kind of need to do this. It's just like if you want to be a pro athlete. So they're waking up to, gosh, what's my strategy for not only surviving, but thriving, in the future? What tools can I be using? And then they, seek us out. And I think Wendy from Billions hasn't hurt people's perception of the coaching aspect of all of it, because what we do is data analytics. But if I just give you some reports about your past behavior, you're going to think that's interesting for, a day maybe. And then you're going to go back to doing whatever you normally do and forget all about it. But if you have a person who, has sat in the seat, has been a fund manager, who can sit down and talk with you regularly and take you through, what is this data saying? What are we going to do about it? That's how you change behavior. And we've seen a lot of success with that. But it's, for some people, that's like a touchy-feely type of, their assumption is that's like a bit cringy. I don't want to do it. And then along comes Billions and Wendy, and people are like, oh, I need to have a coach now. It's like, yeah, you always needed it. There are no athletes who win medals who don't have a coach. So why would you think that you don't need one if you want to win at whatever you're doing? It doesn't.
No, it's true. It's true. I mean, Tin Cup was another one, which is kind of funny, but did you see how, Renee Russo was basically coaching them and showing, but a lot has to do with that. It's like looking at yourself internally there, with patterns and things like that. So what is the goal? So you came out, you have your own company now. Is it, hey, we want to bring this more mainstream. We want to show more results. Is it just bringing out to hedge funds? What's the goal of your company? Because now I'm starting to see you at so many different places. I know Josh Brown interviewed, who I'm a fan of, CNBC, Fast Money. So, what is the goal of your company, and where do you see it, in a couple of years from now? And more important is, from this, is it just about PMs, or is it about, like you have professional investors, but most investors could really do this and look themselves in the mirror and try to see what they're doing wrong, right? Which is very important.
Well, so the ultimate mission here is to help human investors make measurably better decisions. So those are all human investors, not just fund managers. But we started with fund managers because they have large data sets, and they trade enough that you have a lot of data, and those data sets are in a small number of places. So it's not, it's not a totally consolidated market in terms of the software they use, but it's a lot less fragmented than, say, the retail investor world, where every different brokerage has a different platform and they can't get you data out of those platforms, and it makes it hard. All of that said, literally today, so hot off the press, we have just completed on a Series A investment round from a venture capital firm based in London called Calculus Capital, which gives us about $3 million to build further what we're doing, scale, and our first stop is to scale within the professional fund management world. But, we're always trying to figure out how can we deliver what we do to everyday investors, because that's where the meaning ultimately gets, realized. There's a quest here. It's not just about making money. I mean, it's obviously partially about that, but it is ultimately about the meaning is baked in. We want to help people make better decisions and change for the better how being an investor works.
Yeah, and it makes sense because when I describe that to people, I say it's Michael Lewis compared to Muhammad Al-Arian, where, Muhammad Al-Arian will write about economists or the economy and target a smaller audience. But when it comes to a bigger audience, Michael Lewis is fantastic, right? I mean, how big the audience where he dials it down, he explains terms and stuff like that, where bring it to the individual investor. But I could see that being huge. I mean, there's people that are doing it in our industry right now, just trying to fine tune it for individual investors to learn more, whether it's just stop losses, really going through their trading activity of how they could, lower their risk and improve their gains and stuff like that. But, it's definitely here in data, but it's amazing how it filtered down to individual investors, right?
Well, and I think there's the medium step on that is for all RIAs and wealth managers to be engaging in this sort of data-driven feedback loop themselves about their own investment decision-making, because I think it's hard to sell yourself as a behavioral coach if you're not actually eating your own dog food, as they say in England. At Essentia, we do a ton of this. And in fact, we're just talking to a company that does the same thing, but for software code to help you see where are you coding well and where, what are you doing well and not well. And I think there's such an opportunity for the RIA layer of the market to engage with this and set a good example. But even that it's a very fragmented market. There's a lot of different data sources. It's not straightforward.
No. Well, listen, Claire, I mean, I'm fascinated by this stuff. I could talk to you for another 2 hours, but we try to keep this at 20 minutes. And I think we're at 25 minutes already because it was so interesting to me. And, I really appreciate you coming here because I know how busy you are. I've seen you everywhere and how you're expanding with your company, Essentia. But if someone wants to learn more about you and just learn more about, the behavioral analytical side, how could they do that?
So our website is Essentia, which is spelled like essential without the L, -analytics.com. And on there, we have lots of white papers. I definitely recommend joining our Thought Pieces mailing list. It's not marketing stuff. It's actual thought pieces. So if you're somebody who's interested in the application of behavioral science to investing, there's lots on the website for you, and feel free to get in touch.
Well, thanks so much for joining us today. Again, like I said before, I know how busy you are. I see you everywhere. And for me, doing the research on you is fantastic. I really got into this interview and just wanted to learn more. And I know it's going to transfer over to my audience as well. But I really think thanks so much for coming on. And hopefully you'll join us again soon. I'm going to be signing up for your white papers and stuff like that and learning more. But I really appreciate you coming on.
That's great. Thanks so much for having me. It was fun.
All right, guys. Great stuff from Claire. Look, I love that interview personally, because I can identify with that. I identify with her. I'm not going to say she reminds me of myself because she's probably a lot smarter than me. But just someone that wasn't satisfied, doesn't have an ego, always trying to improve, become the best. Willing to go out there, for me, listening to other people's investment styles to learn more, even if I don't agree with them, even if it's some kind of crazy technical analysis or whatever, you may be able to take one component from that or whatever. For me, it's always, making myself better, always trying to improve to become the best. That's what you need to do, right? To become the best in anything. Sports, your job, my job as an analyst, you have to learn from your mistakes. You have to embrace them. Figure out ways how you could become better. For me, that's why I focus more on my losers, on my stakes with you, than my winners, because you're not going to learn anything from me saying, look, AV, Air Environment's up 300%. We took profits. Viper Energy, we did great on this. I told you so. Viper Energy and Invite up tremendously. And those are three stocks that we did well on. We took profits, when these names like triple-digit gains last year. And you hear that a lot, especially in the newsletter industry. For me, I'd rather focus on, hey, what do we get wrong? If it's Diebold, if it's GE, how could we improve it? How do we make that performance better? And that's what I'm trying to teach you as an individual investor. And hopefully that interview went over pretty well. But with that said, this podcast is about you. It's not about me. So let me know what you thought of that interview at frank@curzioresearch.com. That's frank at curzioresearch.com. Now let's move on to the Vancouver Resource Investment Conference, which is the VRIC. So my presentation on the first day, which is Sunday, it's on digital securities. It's a big crowd, standing room only, which people started to pile in about 5 minutes into the interview since the Rams and the Saints game was on. Remember, this in Canada, so they don't understand this. Otherwise, you're not going to see another conference on a Sunday during, the championship playoffs in football. But anyway, that's okay. So there was a TV just outside. There was 6 different, rooms. I was, I think it was room number 6 or whatever. There happened to be a TV there. And believe me, if I wasn't speaking right after the conference, people were talking to me. And I'm like, yeah, right after I spoke. And I'm like looking at the TV because the game went into overtime. It's fantastic with the Rams won, which you guys know. Anyway, I won't go over that blown Saints call, which is insane. But I had a ton of follow-ups after I was done. The interest was amazing. And the timing of the IBM securitized deal, which announced yesterday, they're going to work together to tokenize the 80-plus trillion corporate bond market. Again, just makes sense. This trend's here. I was laughed at when I said, listen, I truly believe it's going to be a $1 trillion industry inside 5 to 7 years. And it's an industry that's just, didn't exist. And now you're seeing over tens of millions, not hundreds of millions of dollars starting to be raised for digital securities. Again, these are not the current thing that's on the market now where you're not getting equity stake and utility tokens. It's totally, totally different. And it's funny because I had a millennial come up to me after my speech and argue with me. Say, if Bitcoin crashes, yours is going to crash. I'm like, it's an equity stake. He's like, what about proof of stake? I was like, yeah, he just didn't. And I love it. I told him because we were going back and forth and there was people watching. I said, look, I love your passion. I said, I think, I love this. I said, we disagreed. In a world where politics, if you're a Democrat or Republican, you need to hate each other. You have to hate each other, the way it is. It was cool that we just had difference of opinion. He's like, look, I love what you're doing here. I think it's going to be big. Yeah, but he just had, just questions. And I think he did not understand that you're getting an equity stake. You could get paid a dividend. We tend to pay a dividend on this. And, that went very, very well with the audience. It's which is really cool. And again, a lot of people are asking tons of questions. A lot of people and CEOs, managers I talked to love the idea. And then I'm telling them, listen, I gave them examples of what's going on. I said, this is huge. And sure enough, the IBM deal came out and, they got word of it and said, holy, you know what? This is, you're dead serious about this. This is for real. I was like, get involved in it. You have to get involved in my company. I get it. Maybe you see something, whatever, but start learning about tokenization. It's very important. It's here. I mean, look at it, Mark, 300 trillion in global assets when we're taking in account the bond market and real estate. Again, these are illiquid assets that can easily sell off 10, 15% of their stakes to individual investors. And just 0.5% of these get tokenized. There you go, which makes so much sense. It's scary, right? You don't need investment bankers. It's cheaper. You can bring this directly to individual investors like you and I. But at 0.5%, we're talking about a $1 trillion market, just at 0.5% market share. And I truly believe that's conservative. So, by the way, awesome earnings on IBM, because IBM did make that announcement with Securitize, who is our partner, which is great. We've been using them, and they're doing everything behind a token. The most important part about using them, with someone like IBM's even using them, is the qualifications and the checks that they do, right? Which is what we want to do. So it's going to be a little bit more if you're used to investing in traditional private placements. You might have to show proof. Well, you will have to show proof of being a credit investor. You don't just have to check a box. But this allows us to go to exchanges like T0 Coinbase, which T0 announced that they're launching this week. Coinbase is pretty close as well. And then you're going to see more than a dozen of these things being launched for 2019. These regulated security exchanges, which are going to trade more like E-Trade, not like Binance. If you notice, I think it was Bittrex, and there may have been one other that said, oh, we're not going to trade in the U.S. because they have people that are trading on their platforms that are not checked out. And these are people that maybe don't want to report taxes or what you need to report to the IRS, right? That's what you want. You want this to be regulated because, as you can see, what IBM and Securitize is doing, it has a potential to open up trillions. I mean, just in a bond market alone, not just the equity market of real estate and liquid assets. So it's huge potential, but people need to know that their money's safe. You need to, if you're making money on these things, you need to pay your capital gains, the IRS, just like you do with a stock, and that's coming and it's here. Now you're going to see this a lot, guys. This is one of many announcements you're going to see with a lot of the big players starting to go in because regulation is close to the brokerage firms. You know, guys like us, we're doing Reg D filings where, you know, you have to register with the you register with the SEC, but you avoid that where you don't have to report to the SEC. But when you're looking at a brokerage firm, that's different. So these guys need to get the rules in place. The SEC is working with them. And once they do, you're going to see a lot of these institutions, which you're starting to see already, especially on the tech end, start jumping into this industry. So, you know, IBM, great announcement also with earnings. Stocks up nicely today. The recommendation of ours, now above a buy up to price. That's why I mentioned it. There's another name that people thought, hey, you're crazy to recommend. It's not. Listen, it's dirt cheap. And I mentioned it last week during my podcast where I covered the CES that they were a big winner at this year's show. People were interested. You're finally seeing the transition. It took a long time. All the negatives were priced in of 22, 23 straight quarters of them, you know, lowering revenue or not growing their revenue. But it's here. They're making the changes. They're into some of the biggest trends in blockchain technology and AI. Red Hat deal is going to be fantastic for them. They work with them for many, many years. They like each other. I think the integration is going to go smooth. If it does, the stock's easily going over $200 a share. It might sound crazy if you look at the share price, but guys, we're talking about a company that has a small market cap compared to a lot of its competitors. What is it, like 120? It was below 100 when I think I recommended it, close to it, but it has moved up. And you're looking at some of the biggest companies in the world, similar technology, a little bit better, but now they're getting into hybrid cloud, competing with Microsoft and Amazon, which have $600 billion plus $700 billion plus market caps. So having IBM double here from a share price point of view looks crazy, but remember, it's all about the market cap, the shares outstanding. It's not so crazy, and these guys are getting it done. And one of the few companies during earnings season that actually raised their guidance, which is pretty impressive. But anyway, tokenization, loving what's taking place. Continue to believe it's going to be a huge market. Please start learning about it, whether through us or not. If you're interested in our security token, it's going to give you an equity stake in Curzio Research, which allows you to grow with us, be partners with us, which does not offer any place else in this business, which is really cool, right? Not just buying a newsletter and everybody else makes out, no matter what the point. You own a piece of our company. We intend on paying a dividend. I have to say the word intend. Even in the first year, where qualified investors are going to be locked up for 12 months. That's a pretty cool offer. I don't know anyone else that's locked up when you're going to get paid a dividend. You're just going to have access to all of our paid newsletters and future newsletters for free based on your investment amount, which is something our competitors charge well over $20,000 for, up to $40,000 for, I saw. But it's set up as a good deal for investors, one of the best in the crypto space. If you think that it's not, please send me something, but I haven't seen anything even close to it. And that's why we're starting to see lots of demand from institutional investors. Since we filed our Reg D already, and this, I guess, is, kind of like if you buy a house, it's like public record or whatever, but a lot of funds, just sit on those emails, see what's going on. And, I didn't anticipate that, but a lot of them reached out and said, hey, we're just interested in learning more. No commitments or anything. We're going to start setting up meetings with institutions probably for the next 2 weeks or so. With that said, in the first 2 weeks of our launch, which I promised, just weeks away, I'm only going to open up to individual investors, listeners, subscribers, and everybody will get a special 10% bonus. So we're looking to raise $12 million in our offering, $25,000 is the minimum, only available to accredited investors, which is the way we have to do it, guys. That's the way I would love to. But 12 months from now, once the token goes free trading, anyone could buy it. And it's still going to represent an equity stake similar to a stock. But at $25,000, you're going to get, an extra 10% bonus. There's $2,500 worth of tokens. At $50,000, $5,000. At $100,000, again, you're looking at 10% of those tokens, 10,000 tokens. So, which is something, guys, I'll be honest with you. I don't have to do with this offer. A lot of those discounts and bonuses come with a lot of other deals, but we're already giving away an actual equity stake, which some people are still not doing. And not only is it equity stake, it's an equity stake in an existing company. So the money we raise isn't used to spend $100,000 to build the token. I paid for that out of my own pocket, out of our own pocket with Curzio Research, where that's going to be done through securitize. So the money's going to go to growing this company, to marketing, to hiring more people. So, and not only that, we intend on paying a dividend. And Like I said, investors are often going to get free products and free services. But why am I doing that? Why would I offer a bonus? Because it's my responsibility to do so. I mean, we're doing this for the long term, but I would have never started this business, Curzio Research, without all of you. I mean, sometimes I think that gets lost even on actors where they come out and they have all these views. And, remember, the reason why you're famous is because people watch you. Not that I'm famous, but the reason why we're able to establish this company is because people care. They care about their investments. They love our content. They see what we're doing. Without that, there's nothing. So for me, we want to be able to, partner with the right people, help everybody out. We want you to be part of our business, have that equity stake, and just do what's right, which is like a lost freaking art these days, right? Just doing what's right, not doing what's for yourself. Because if you think long-term, you do the right thing, I'm not looking as people coming into this deal saying, oh, wow, I'm into this deal. No, I'm looking as every deal we do over the next 20 years, you're partners with me. And that's the way that I've learned from great hedge fund managers and people I respect in this industry. Don't look at the one-off. Oh, yeah, let's raise this money and do it. No, that's what we saw a lot in this freaking industry, which crushed these things. These guys are just giving away tokens to anybody, selling whatever they want. It's crazy. But you know what? Sometimes you just do the right thing. That's how you build a long-term business. That's how you have credibility. That's why I've been around for 25 years doing this. I'm not in it for the short term. So the first 2 weeks, deals for you. The whole $12 million gets taken out by you. That's cool. We're not raising the amount. And we see that a lot, right? If a fund goes and tells us to say, hey, Frank, we want to give you $10 million after we already raised the $12 million, we're not taking it. This $12 million represents a 25% equity stake in Curzio Research. And you see that a lot with regular private placements. We're looking to raise $20 million. We're looking to raise $50 million. Oh, it's oversubscribed. We're looking to raise $75 million. Not such a good thing sometimes because you're diluting shareholders even further. We're not doing that. Again, looking at the long term. They're not going to be upsizing this offering and dilute shareholders. Of course, there's risks, as you know. We highlight every one of them in the SAFE agreement, which you're going to read. I'm going to encourage you to make sure you read thoroughly before you invest in our deal. I'm excited. Awesome. Getting some really good feedback to encourage your research into a big player in the financial newsletter space to better compete with the big boys who many generate more than 30 to 40 times our current sales. And I truly believe this, guys, that our content is better, our management team is better, and our analysts are better. And that's why this is working. And that's why we're able to grow so fast in the first 2 years. Moving on from tokenization. The VRIC was great. I was super surprised at the turnout. How many people there? I mean, it's pretty crazy. The disappointments, which I'll go over first, it's just so many companies struggling right now and they need financing. I'm looking at like 80% of them, which is normal. Juniors, they don't generate any sales. They're just looking for money to drill in prime areas. And hopefully, that great discovery is going to lead to an acquisition by a major. But it's not fun when you're looking to raise money when your price is down 60, 70, 80%, which is the entire industry. That's one of the disappointments what I saw. But the positives, this is important, guys. I finally saw companies talking about technology, how they're going to use different technologies in the industry to lower costs. Because mining is the worst industry in the world. I mean, very high costs, low margins, commodity based. You can do everything right. If gold falls to 800, you're done with a lot of these projects. But like we saw in oil, shale drilling, hydraulic fracturing, horizontal drilling, what did that do? It allowed drillers to make money at sub $45 oil prices. Yes, some could produce at 28, 29 with a couple of wells, but the average is around 45 when you're taking all the major shale areas in the United States. Much better than $75, $80, which it used to be before 2010. Huge difference when it comes to margins, especially in the market right now where oil prices are. Most of these guys couldn't make money. Today they're drilling. I mean, how come this hasn't happened in gold, like in a century? Nothing. Like, yeah, 3D seismic, I get it, but nothing like really, But anyway, I saw companies starting to use big data analytics, AI, to help find these discoveries, lower costs. By the way, we're delaying Curzio Venture Opportunities to Friday. It's supposed to come out on Wednesday. And there's a couple delays lately. And these delays aren't because I'm lazy. I don't feel like doing anything. But you're going to see that in January, guys. It's just a crazy month. I talked to you about it December where I need to attend conferences personally because that's where I find the best ideas for you. So, attending the San Francisco Cambridge conference in November, then the CES a couple weeks ago in Vegas, right? Flying out there from Florida across the country. And then, this week is the VRIC, which is in Vancouver. It's a lot of work and, I'm writing my stuff, but, guys, it's important being in the room. I talk to you guys about this, talking to management teams directly, speaking at these events, going to dinners, having a few beers with these guys, how important that is when it comes to research and finding the best ideas. And, look, I'm a hands-on analyst. I'm not sitting here running this company from a desk and saying, yeah, you did it. No, I love this stuff. It's part of my job. This is what I do. I love it. This is how I'm training my analysts. But January is a crazy month. Anyway, you're going to receive your next Curzio Venture Up newsletter on Friday. And I'm sure you're really going to love the new pick. Spent a lot of time on the research on it. So real quick now, just a quick rundown. Some companies that impressed me. Nevada Exploration. I mean, I've had Dennis Higgs on this podcast before. And, I met him where instead of talking about our company or his company and, highly recommend that someone's very successful in the industry. Instead of basically talking to him at a bar, he said, hey, you want to come up my plane and fly it? He's got these, a great old plane and just awesome. He flew me off a Whistler and, we just hit it off. And I love the idea. That didn't influence my decision at all. It just made it more fun to talk about a stock instead of doing it, at a bar. He did have a private placement, which my investors got into. As a CVO subscriber, that's available. It's available to you for credit investors. And you guys are doing amazing on that deal, which I'm happy about because we did have a few private placement deals in the mining industry that haven't performed well in a market that remains pretty much in a super bear cycle. But you look at Nevada Exploration, actually came out with news this morning. It's up 10, 12% last time I looked. I think maybe even more now, but I see a lot of more upside in this name. Revival Gold's another one. Hugh Agro I had on my podcast. Just an amazing leader. Those two guys are just two people that really don't have to do this. And they just see a great opportunity, and they're looking to develop they're not looking to just claim the stake, and hopefully you're going to have a major go out there and say, hey, we love what you do, and we're going to buy you. That strategy hasn't worked for a lot of people. They thought that would happen over the last 3 years, and what happens is you got to continue drilling, got to improve that asset, you got to spend more money, raise more money, and in a market where these stocks continue to get hit, it hasn't worked. These are guys that are looking to develop it's a different mentality. Of course, if they get the right offer, they're going to sell, just like anyone should, right? It's a public company. But, Hugh Agro is just amazing. It's a stock that's actually performed well. By well, it's not down since I've had him on. It's been in 70 cents area over the past year, despite, the company making amazing announcements, including upgrading, improving its resource numbers, where the rest of the industry is really, really sold off. So these are two companies I think that would take off tremendously if we see a bottom in that cycle. Which I think is coming. And I really got the chance to dig in with Alkin, who is, like a superstar at these shows now, taking selfies with people. I told him, hey, man, remember us little guys? I was walking by him. But, I love to see that. Just a great analyst, someone who cares about his subscribers, doing very well with his Money Flow Trader newsletter. And it got off a little bit of a rocky start at the beginning because, we saw a super bull market. And that newsletter is basically designed to use conservative option strategy to bet against individual stocks. And then, when the market really came down and he started doing well, even before that, he's made some incredible gains for investors. And guys, look, I really pride myself on putting products in front of you that are going to make money. And I just thought it was a great time to launch that product. Big deal. We were a couple months early compared to if I launched it 3 years ago, but where everyone was predicting the market's going to crash every single day. But the timing was good, and it gave you a chance to make money on stocks, learning a conservative option strategy where you're not going fully short and, you have your unlimited risk. And you know what? A lot of people who subscribe to that newsletter did very, very well in a market where almost everybody else got killed. So it's something that, I'm proud of Alkin and the job he's doing is fantastic. Anyway, he's also really into the uranium space, one of the best analysts covering it. And just, got a chance to talk to him about some of the things that are really exciting, at least from his point of view in some of these stocks and things like that. So it was a very good conversation and some really, really great stuff. Also, Northern Dynasty, just had a nice run up after getting destroyed. I know a lot of you emailed me about that. We stopped out of that stuff. We did very, very well on it. We did stop out. I know a lot of you, some didn't sell or whatever. It was one of our biggest winners. And I didn't have it in a portfolio because I was just switching jobs at the time right before we launched our company. But it's a project I went to go see, and middle of Alaska, 2 planes and a helicopter, and came back and said, holy cow. After going there thinking I was going to want to short the stock at 40 cents, I said this stock should be trading at $1.50 easily. It went to $3. Some people did get into financings and stuff like that, but it was a just incredible opportunity for subscribers, which was awesome. And it went up 900%, I believe, in 7 months since we got back from that place. And then, it did come down, but, Northern Dynasty is doing everything right. The political environment is much better for them. And it's something I talked to management, still like the company. I think it's pretty good. Even the last conference, they were up after me, and I gave them a shout out instead of, I think it was like 40 cents again, telling, hey, guys, at this price, I think all the risk is factored in. The stock is like around, 70 cents now. So, and I said that at the conference, and I know a lot of you saw the video and stuff like that. But those are some of the names I like. I like to see this cycle turn first before, I'm really going all in on a lot of this stuff. But the cycle, it is doing a little bit better, right? We're seeing gold prices start to rise a little bit. You have to look at market conditions, guys, because that's the most important thing when investing in this sector. Forget about when people say, mining, the most important thing is people. Well, you could have had the Pope or whoever, or the biggest person in the world, whatever, at the head of your mining company, and you're down 60, 70% over the past couple of years. So it's not people. It's really trying to focus on market conditions, which is not easy to do. But we're looking at, interest rates. Hey, you look at the Fed's going to stop their tightening cycle in 2019. I don't know if it's going to be one more hike, two more hikes, whatever. That should be positive. These mega mergers, see how they're going to influence stocks or the gold sector going forward. Innovation technology coming out, just a lot of positives. Again, I saw innovation technology for the first time ever at these conferences, which is really cool at a mining conference. But once we really see that bottom being put in and money coming into this industry instead of still seeing redemptions where, stocks are going up higher after they report good news. It's not being used as a selling event to liquidate even more when they report good stuff. Once we see that, I'm going to get a lot more positive on the sector. But those are some of the companies that I really, really like right now. So, I'm not running on fumes. Still got a lot of energy for you guys. I covered a lot in this week's show. Really hope you enjoyed the interview with Clare Flynn Levy. It was awesome. I liked it. I like her a lot. Also going to be sending my presentation I did at the Vancouver conference a couple days ago. It should be online soon. I'll be sure to send it to you. This way you guys can see it all updated about tokenization. Again, got tons of questions, high demand. It was really, really cool. It was just well received, which I like, and lots of questions afterwards. So if you're a credit investor interested in learning more about digital security or our digital security offering, send me an email, frank@curzioresearch.com. That's frank@curzioresearch.com. Guys, even if you're not interested in this, please start learning about this industry. It's amazing. It's innovative. I just came back from the CES. There was nothing really innovative. They're just focusing on accelerating the best trends. A lot of good ideas there. This is innovative. This is game-changing. It's going to disrupt tons of industries. So if you're interested, again, frankcurzioresearch.com, and I'll be able to send you our white paper shortly, which is going through one more final review through legal. So we're looking at a week or two away. I'll be sure to send you all the information on it once it is official. So, guys, that's it for me. Thanks again for all of your support. Really, really appreciate it. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.